So you may have heard somewhere that the average millionaire has 7 streams of income. What does that really mean? I think there's a lot of myths around that and what people think that actually means. And in this video, I'm going to break down exactly what that means and how you should look about it when it comes to having that 7 streams of income. Hi, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. The number one thing that people should know about having the 7 streams of income, it doesn't mean that the person that builds wealth or becomes extremely successful financially, that they focus on 7 different things. What it really means is they mastered 1, maybe 2 things, and they learned how to do those things extremely well, where they basically built a high value skill and they're able to charge a certain amount in the market. And later on, when they make that money, they use that to invest in different things, whether it's stock market, real estate, cryptocurrencies, all these different types of investments that you can, all these different types of investment classes that you can put your money in. It doesn't mean that they spread themselves thin and try to become an expert in everything. Because I'm sure we've all heard the jack of all trades, the master of none. And no one wants to really be that, and that's why it's really important to make sure that you find something that you can specialize in, that you believe that you could build a really good skill in, and later on, as you develop yourself in that space and you become an expert, you can charge more for your service, whether it's through an employer or you have your own business and you really have an expertise or a niche in what you're doing. Yes, it is important to diversify, but in terms of skill set, you don't necessarily have to know how to do everything. You just need to know how to do a few things really well, and then later on delegate some of those tasks. Or when it comes to investing, whether it's investing in real estate or whatever it is putting that money aside into asset classes that you know or you believe will grow over time. And one of the things to really pay attention to is about people that end up really building wealth and really becoming financially successful. The first thing they make sure they do with their money is they actually make sure they invest in income or capital appreciation producing assets. They don't put their money into consumer items or anything like that depreciate in value. They make sure the first thing they do with the money that they earn from their skill or their job or their business, they use that money and make sure they invest into different types of asset classes that grow over time. But anyway, now that I got that out of the way, I'm going to start with the 7 streams of income that you might be curious about in terms of what millionaires have or what wealthy people have. Nowadays, I can't necessarily even say that the person with $1 million is wealthy anymore, because nowadays $1 million for even retirement wouldn't even last that long for people that are in their 60s. So let's just say what wealthy people would do in terms of having that 7 streams. Like, what type of streams of income do they actually have? What type of asset classes do they actually have? So the first one is pretty basic. It's their salaried income. So a lot of people, they have a work from, whether it's they get paid from their personal business or they work for an employer and they get paid a W-2. This is the income that we all know about. And the funny thing is, it's the highest tax income. So the different types of taxes you have to pay are federal tax, state taxes, Social Security tax, Medicare tax, local taxes. I'm pretty sure I'm missing a few other taxes that you have to pay in terms of your working income. So this is why it's the hardest to become even a millionaire just by working a regular job, or even if you have a high income job, it's really hard to build yourself to that point to become a millionaire just through using your salary job, because of the heavy taxes that are associated with working income. And this is why learning about things like investments and all these other things that I'm going to be talking about in this video is really important, because in order to get to that point that you want of financial stability, whether it's retirement or financial freedom, or whatever you want to call it, whatever your financial goals are, it's going to be really important to put your money in the right places to put yourself in a position to win in the future. And the next type of income that wealthy people would have are capital gains. So this would generally be if you buy a stock, let's say at $100, let's say you buy Apple stock for $100, later on in the next few years it appreciates to $200 in the next 2 years, let's say, and you sell it off. So you got $100 profit on that. And the good thing is, since you held it over a year, if you would only have to pay long-term capital gains versus short-term capital gains, which is a higher tax. And that's one type of income that wealthy people have, is they invest in things like the stock market. They hold them over time so they could qualify for certain tax benefits. And basically the income comes from the appreciation of whatever stock or equity, or whether they bought a home that they sold later on. That appreciation is basically what gets taxed, which is called capital gains. So whenever an asset appreciates in value and later on you sell it at a later date, you pay taxes on that appreciated value. And the cool thing is, when it comes to capital gains, you only pay taxes on capital gains when you sell the equity that you have or sell the home that you have. You actually get some type of tax benefit known as unrealized capital gains. So the longer you hold, you're basically growing money at an amount that isn't taxable because it's unrealized. Until you sell, all that money is compounding and growing along the way. You only would pay taxes on, say, either dividend distributions or income distributions. If you're not getting those, like some companies like Amazon, they don't pay any dividends at all, which is actually, if you have an objective of growing your portfolio or growing your money in the early stages, it's better to not get dividends, because more of your money is growing without you having to pay taxes, which is the beneficial thing about capital gains. And you only need to sell when you need money. So that's the second thing that wealthy people use to grow their money. Now, a third thing that would be considered one of the 7 streams of income is business profit. So let's say that you have a business, right? Let's say you have a pizza store, let's just for example, and it generates $1 million worth of revenue. So this isn't actual profit, this is revenue, which is a big difference. Actual profit is what comes in after all the business expenses are paid in terms of employees and staff and equipment and all those things, and inventory or whatever you have to spend money on. Let's say your expenses end up being $400,000. So after you pay for employees, overhead and all these things, you have $400,000 worth of expense. So now your actual profit now is $600,000. So you can choose to pay yourself a salary or a 1099 income through your business, and you could say you pay yourself $100,000. You would pay taxes like a typical self-employed or employee if you pay yourself $100,000 through your business. But after that, there is a $500,000 profit left. And now what you can do, which is a little bit more of a benefit rather than being like an employee that just gets paid a wage, what you can do if you have a business is you could reinvest that capital into your business, similar to having a stock in a way. So when you have stocks and you have that ability to have unrealized appreciation, same with your business. When you reinvest in your business, we want to think about it as you growing the stock of your own company. So when you're putting more money into your business, you give your business more opportunities to grow in the future. And the thing is, you could write off that entire $500,000 if you want to. So you can invest into more employees, either more inventory that's going to help your business or whatever it is, and not pay taxes on the money that you would have paid taxes if you took all the income for yourself. Well, the reason why businessmen get these tax breaks is because obviously there's a lot more risk involved. So employees can't necessarily get those same tax breaks because the risk involved for an employee isn't as much as the person running the business, because they have to hire employees, buy inventory, and all those different types of things that come with risk of running a business. But the thing is, if it goes well, it ends up being some great tax benefits that you otherwise wouldn't have qualified for as a regular employee. So that's known as business profit, 1099 profit, or basically profit that you get before taxes. And that's the benefit of being, say, an entrepreneur or being in business for yourself, right? Number 4 would be considered dividend income. So what is dividend income? So let's say you buy a stock of a company. Let's say you buy Bank of America stock. So currently, I believe their dividend is around 2%. From the last time I checked, it's somewhere around that mark. So basically, having ownership of that stock, based on the value of the stock, you're gonna get 2% of whatever that value is. So let's say the stock is trading at $100. You get 2% of that. That's $2 in terms of income that's going to be paid out to you as a shareholder of that stock. Doesn't sound like a lot, but if you have a lot of Bank of America stock, that could end up paying you a lot of money, right? So that's the thing. It's all about a game of accumulation and growing your assets. And one thing to note is when you're growing your portfolio, you want as little dividend income as possible. Once you get to the point where you actually have a decent amount of money accumulated in assets, then you might want to have more dividend income. So the thing is, when you're growing your portfolio, dividends are taxable. So that's one thing you want to make sure you know. Dividends are taxable, so it always have an effect on your portfolio as you're growing it, versus if you didn't have to pay any taxes on it. And obviously there's things like different types of retirement accounts that you could use for certain tax benefits, but I always tell people that you should have a strong understanding of your financial goals before you use retirement accounts, because it's a very high commitment thing to put your money in a certain account, locking it up essentially for, say, up until 6 years old, and not even knowing what your financial goals are. So that's one thing you want to make sure. You want to kind of outline what your financial goals are to understand what strategies you're going to use to grow your portfolio over time. It's not a matter if you're going to invest, it's about how exactly are you going to invest based on your goals and what's the most effective way to reach it. So everyone's financial goals are different, not everyone's are the same. So it's all going to depend on your situation and what you want to do. But generally, you want to lower your dividend income when you're growing your portfolio, and maybe when you get to the point where you're established, then you might want to have more dividend income so you could get income from your investments and you don't necessarily have to sell the assets that you have. So you still have that appreciation potential with your stocks or your funds and things of that sort. So that's number 4, dividend income. Number 5 would be interest income. Well, the thing is, the bank makes interest on us, right? So you wanted things about credit cards, mortgages, lending out money to other people, and all those type of things that the banks do to make interest on us. And basically what you can do if you want to make some interest in a way, you can get a CD from a bank, because it is a bond that you're buying, so you're getting the right to have interest income through that. But the thing is, CD rates with interest rates being so low pay close to nothing. Most of them pay under 1%, and it's not going to give you a high yield whatsoever. So another thing that you can do, and what a lot of business people do, is they get into private lending, meaning that they're the ones lending other people money versus the bank doing it, and they get a higher interest rate from doing that private lending. So that's another thing you could do. You could lend out money to business plans that you believe in, or certain ventures that you believe in, and get paid interest on them. So obviously you have to make sure you do your research and all those type of things, and you want to make sure the person that you are actually lending out money to is actually going to pay you back. So there's a few things that you would have to watch out for when it comes to private money lending. Obviously it's more risk, but if you're trying to have a higher return versus CD rate, it might be well worth that risk. That would be interest income as 5. And number 6 would be royalties. So people have things like books, even things like YouTube channels, like people get paid royalties for certain videos being played over time and ads being played on those videos. So there's a variety of different ways you could get royalties nowadays. Before it used to be mainly books, but now there's like social media channels. That's a way that basically every single time someone either buys a book or watches a YouTube video, you could get paid a subscription fee or paid a fee through either advertisers or people that have bought your services or your book or whatever it is. And that's one thing that wealthy people do, is they'll write books and they'll get paid royalties based on that. And lastly, real estate income. So this is actually a great way to actually get income, because there's a lot of tax benefits involved with real estate. So there's something known as depreciation deduction. So basically, for a lot of real estate properties, you get that benefit of depreciation deduction for close to 20 to 30 years, depending on the property that you buy. So basically, a lot of the income that you're getting, or the rental income that you're getting from your property, you can deduct a lot of that from your taxes. So basically, you're getting a tax-free income source. So it's a really great way to get tax benefits, especially as your net worth increases and you increase your tax brackets over time. You want to find more effective ways to grow your money, and real estate is one of them. Real estate is another way to get cash flow. You lose a little bit of liquidity, but you do have cash flow of money coming in every month to pay for things like expenses, bills, or even give you consistent income to fund different ventures in your business if you have one. Those are the 7 different types of income that wealthy people have. a lot of times it's not actually broken down because obviously we don't learn these things in school. So I thought I'd make a video to kind of breaking down simply on what the 7 different streams of income is. So if you found some value in this video, go ahead, like, comment, subscribe, and I make financial content essentially every single week. So go ahead and hit the notification bell and leave a comment below. And as always, in the description below, if you have any questions, whether it's about personal finance, investing, or different types of savings tactics, feel free to book a call with me and ask me any questions you want. Thank you.